Something absolutely unprecedented just happened in the silver market that most people completely missed. While you were celebrating the new year, the entire silver pricing system that has controlled this market for 50 years silently collapsed. And I'm not exaggerating when I say this changes everything. Between December 30th and January 2nd, 2026, physical silver in Tokyo and Dubai traded at $130 per ounce. At the exact same time, the COMEX paper price showed $72. Read that again. Physical silver was trading at an 80% premium over the official spot price. This has never happened before in modern precious metals history, ever. Smash the like button right now. Drop a comment with where you think silver is really trading in your area, and subscribe for more silver content, because what I'm about to reveal will completely change how you view the silver market. This isn't a small discrepancy. This isn't a regional anomaly. This is a systemic breakdown of the paper pricing mechanism that has governed silver for decades. And here's what makes this absolutely terrifying for anyone holding paper silver claims. The COMEX is running out of physical metal to deliver, and they know it. Let me paint you a picture of what happened in just 7 days. Between early and mid-January, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery. That's 26% of COMEX's entire registered inventory gone in 1 week. Not rolled over, not cash settled, actually withdrawn. Physical metal leaving the vaults. When you see that kind of drainage happening, that's not normal market activity. That's panic. That's institutions and industrial users who suddenly realized that the paper promises they've been holding might not be backed by real metal, and they're demanding delivery right now before it's too late. Here's where this gets even more interesting. Normally, in futures markets, traders roll their positions forward. They take a contract expiring in January and roll it to March, to May, to July. That's how the paper game has always worked. You maintain price exposure without ever taking physical delivery. But something bizarre started happening in early January. Open interest for the January 2026 contract increased by 1,431 contracts in a single day, while March open interest dropped by nearly 3,000 contracts. Traders were rolling backward, not forward. They were moving from longer dated contracts into contracts that expire immediately because they want the metal now. They don't trust that it will be there in March. John Lindau, a silver market analyst, explained exactly what this means. When traders roll backward in normal markets, it indicates immediate scarcity of physical silver. People are choosing to take delivery instead of maintaining paper exposure. This creates what's called backwardation, where spot prices trade at massive premiums over future contracts. And extreme backwardation is exactly what we're seeing. The market is screaming that silver you can hold in your hand today is worth far more than silver promised to you 3 months from now. Why? Because the market doesn't believe that silver will actually be there in 3 months. Now let's talk about the elephant in the room, the paper to physical ratio. For years, the silver market has operated with approximately 356 paper claims for every 1 ounce of physical silver that actually exists. Think about what that means. The system created 356 times more promises than metal. This fractional reserve system only works if nobody asks for delivery all at once. In early 2026, that assumption failed catastrophically. Smash the like button if this is starting to make sense. Comment below if you're holding physical or paper silver, and make sure you're subscribed because we're about to get into the most shocking part of this story. Here's where the global pricing system completely fractures. In Shanghai, physical silver premiums exceeded $8 per ounce above COMEX prices throughout late December. Indian buyers offered $5 premiums just to secure metal, but those numbers numbers pale in comparison to what happened in Tokyo and Dubai. Physical silver dealers, when they could even find inventory, were selling at $130 per ounce, while COMEX showed $72. That's not a premium anymore. That's a completely separate market. When paper and physical prices diverge this violently, one of two things is happening. Either the paper price is completely fake and manipulated, or there's no actual silver backing those contracts. Based on the evidence, it's both. And this isn't conspiracy theory territory anymore. Between 2016 and 2025, global banks including JP Morgan, UBS, HSBC, and others paid over $1.2 billion in fines related to precious metals. Price manipulation. Multiple traders were criminally convicted for placing fake orders to manipulate silver prices. This is documented fact, settled in court. But here's what's different now. For decades, these banks could suppress prices by flooding the market with paper contracts. When silver tried to break out, they'd sell massive short positions to drive the price back down. But that game only works if there's sufficient physical metal to deliver against contracts when someone actually stands for delivery. In 2026, that physical metal is gone. The vaults are empty, and now the banks are trapped. December saw the most dramatic example of this crisis. COMEX faced a delivery demand of nearly 65 million ounces, a volume the exchange reportedly struggled to fulfill. Rumors began circulating of cash-only settlements where instead of delivering physical silver, the exchange simply pays cash based on the contract price. But here's the problem with that. Industrial manufacturers cannot use cash to build solar panels, electric vehicles, or semiconductors. They need actual silver. When COMEX starts forcing cash settlements because they can't deliver metal, manufacturers face an existential problem. If they can't get silver, they can't produce. No production means no sales. No sales means no revenue. So what happens next? They scramble to find physical silver anywhere they can, at any price. And when that scramble begins, the physical market can completely break loose from the futures market. This is exactly what we're witnessing right now. The bifurcation of silver into two completely separate markets. The paper market, where derivatives and futures trade based on leverage and speculation, and the physical market, where real metal changes hands based on actual supply and demand. And increasingly, the physical market is asserting price leadership over the paper market. Shanghai Gold Exchange pricing has decisively broken away from Western paper benchmarks, with premiums reaching 12 to 13% above LBMA spot and COMEX futures. In Japan, premiums on secondary market platforms like Mercari surged to around 60% during peak demand. These aren't small regional variations. This is the market telling you that the official price is wrong. Now, let me tell you about the catalyst that accelerated all of this. On January 1st, 2026, China implemented the most aggressive precious metals export controls since rare earth restrictions. Beijing reclassified silver from an ordinary commodity to a strategic resource subject to government licensing. Only 44 companies received authorization to export silver over the next 2 years. That's it. 44 companies now control approximately 121 million ounces of annual exports, representing 60 to 70% of refined silver traded globally. This isn't about trade policy. This is about weaponizing control over global supply chains. China exported over 4,000 tons of silver in the first 11 months of 2025, while importing only 220 tons. They're a massive net exporter. By restricting that flow, they've effectively ring-fenced 65% of global refined silver supply for domestic use only. Western markets are now in a desperate scramble for remaining stocks, and there simply isn't enough to go around. Comment below if you think China's export restrictions are deliberately designed to break the COMEX, and subscribe if you want to stay ahead of these developments. Here's what makes this situation so dangerous. When the futures market falls into deep backwardation, the message is clear. Silver you can take delivery of right now is far more valuable than silver promised months in the future. What the market lacks is not paper claims on future silver, but metal that can be loaded onto a truck today. Psychologically, this price pattern tells every market participant that there might not be enough silver to hand over 3 months from now. The CME Group knows this is spiraling out of control. In response to the chaos, they issued Advisory 25393, raising margin requirements for silver futures to $25,000 per contract. That's a massive increase designed to force leveraged traders to close positions, which temporarily suppresses price and reduces delivery pressure. But here's what that really tells you. The exchange is so concerned about a total market collapse that they're implementing emergency measures to reduce the number of contracts standing for delivery. But raising margin requirements doesn't create new silver. It doesn't magically fill the vaults. It's a band-aid on a systemic problem. The structural deficit that's been building for 5 consecutive years, the industrial demand that's consuming 60% of total global production, the vault inventories at decade lows. None of that changes because they raised margin requirements. All they've done is bought themselves a little time. So where does this leave us? The silver market of 2026 is fundamentally different than anything we've seen before. Price and value have officially diverged. The digital number on your screen is no longer a reliable indicator of the cost to acquire physical metal. If you're holding paper silver, ETFs, or futures contracts, you're exposed to a system that's increasingly showing signs of not being able to deliver when push comes to shove. If you're holding physical silver, you're sitting on an asset that's trading at premiums of 50 to 80% in certain markets around the world. The great silver squeeze of 2026 isn't speculation. It's not a social media driven frenzy like Wall Street silver years ago. This is a genuine physical deficit colliding with a fractional reserve paper system that was never designed to handle mass delivery demands. When markets fracture this violently, when physical premiums reach 80%, when major exchanges implement emergency margin hikes, these aren't signs of a healthy market. These are warning signs of a system on the brink of complete breakdown. The lasting impact will be a permanent re-rating of silver as a strategic industrial resource. The world is waking up to a metal that's been underestimated and manipulated for decades. And as more people realize that the paper price is disconnected from physical reality, the scramble for actual metal will only intensify. Make sure you smash that like button, comment your thoughts on paper versus physical silver, and subscribe because this story is far from over. The COMEX is breaking in real time, and we're here to cover every development as it happens.